Our most popular episode to date is our Business Model Canvas podcast. We briefly covered each of the 9 building blocks of the Business Model Canvas in that podcast. In response to many requests from our audience, we are providing 9 podcast episodes addressing each building block separately in greater depth. The Business Model Canvas, developed by Alexander Osterwalder, is a template often used to develop ideas and a monetization strategy for a startup venture. This episode is the 8th of 9 and will cover cost structure.
Our Favorite Tools for Entrepreneurs podcast addresses tools and concepts that are useful for the launch and growth of entrepreneurial ventures. Your 2 hosts will be Professor Gary Palin and serial entrepreneur Ryan Budden.
Hello, Ryan. How are you today?
Fantastically. I'm in Wyoming for the week. Can't complain about anything.
Well, that sounds good. What's the weather like over there?
We've got about 4.5 to 5 feet of snow. This weekend will be my first time skiing in a couple years. Hopefully I don't injure myself, but it should be really fun powder days.
Yeah, I gave up skiing a long time ago because I don't bounce as well as I used to.
Well, for those watching, I look a little like a Viking right now, so I'm trying to really lean into the mountain man persona.
Sounds good. Ryan, today we're going to be speaking about another aspect of the business model canvas, and this one is cost structure. Cost structure refers to the expenses a business incurs in order to operate and generate revenue. So it includes expenses associated with producing and delivering products or services. They can include costs such as marketing, customer service, and other activities. What are your thoughts on when someone is approaching a business model canvas, the cost structure building block?
The cost structure is a really important one because of the fact that it's a big financial viability check. Once you start totaling some of these costs up, you're going to get a really good picture on how many resources you're going to need to get going. What is the barrier from a financial perspective of the business before you can even start?
That can help you both if you're bootstrapping or looking for external funding. You still need to know how much money do I need on a bare minimum to start this bad boy.
Right. I can't tell you how many times I've gone through the cost structure for a good or service and realized very quickly that the price I would have to charge for that good or service to cover this cost structure makes it non-viable. You just can't produce the good or service cheap enough that somebody's willing to pay for it.
I've done that very often too, and it's the back of the napkin financial assessment. And very often that napkin will say, let's move on to something else.
Exactly right. And I often find when I'm helping people go through this, they start adding this up very quickly and coming to a similar realization.
And when I'm making decisions on what to put down on that napkin, if we continue with that analogy, it's what is the absolute critical issues that I need to spend money on and what can be deferred till later. And I'd like to know what is the bare bone minimum I need. And then usually I try to put some wiggle room, 10 to 25% above that if I miscalculate.
Yeah, what's the old adage? It's twice as expensive and takes 3 times as long.
Yes.
I have seriously, in my experience, rings true more often than not.
That is some accuracy to that old adage. Even though I'm saying start off looking at the minimum, you're not going to hit that in all reality.
Even people that have been in an industry for a long time, they're probably used to experiencing economies of scale with goods or services that they're buying. So when they go to purchasing for the first time with a new organization or a company, they realize there's quite a cost.
Economies of scales in a startup are usually not an issue unless you've negotiated with a potential partner that you can share expenses, but that's a rarity to start off with.
That's exactly right.
So your upfront costs are usually higher than an established business, larger business that deals in a lot of volume.
You have no relationships that you can lean on, and you're probably not purchasing in high enough quantities to bring that cost down per unit.
We probably should explain what economies of scale is, but it's basically because of your buying power as you're producing more, the lower your cost is per unit.
Correct. And that unit doesn't have to be for a physical good. It could be for a service as well. What is the hourly cost of an employee that you're sending out? What is the HR cost to employ that person or continue to have them on the payroll type thing as well?
That's another area that I always look at is what is the unit price that I need to charge? So if you break it down, selling one unit or one bit of service to a consumer, and is it a reasonable price to penetrate the market?
The other area, the bling words in this would be fixed cost and variable cost. Variable cost is if you're providing a good or a service, what are the costs that increase if you're providing more goods or more services? So if it's a plastic product, every product that you make has plastic that goes into it. So it's going to increase for more plastic products that you make. Whereas fixed costs are things like rent on an office building, or a warehouse might be an even better example. If you have a warehouse that you just need for a base, whether it's empty or whether it's full, that's going to be the same cost every single month.
And I always look at fixed cost as if I sell zero, I'm still paying that same amount. Rent is an example, as you said, where variable cost is that will increase as I'm producing or selling more of each unit because it's cost directly associated with the sale of the product, and that would be a variable cost.
Another really big example of this that I end up talking a lot about, because businesses that I deal with are typically trying to reduce their footprint so they don't have a physical location, is the cost of a salesperson's salary versus the cost of their incentive program. So whether you're incentivizing through a bonus or some sort of commission structure, the more they sell, the higher that is, but you're going to pay their salary every single week, month, however that pay structure is set out.
The other two areas that I look at cost are direct cost and indirect cost. With direct cost are, as it's stated, directly associated with the production or delivery of the product or service, where an indirect cost will be such as, say, administrative or marketing costs. So it's not directly associated with the production of a product.
Ultimately, if you're getting deep into the financials, you should be able to calculate a return on investment or an ROI based on those indirect costs.
Definitely. Well, that's just an overview of the cost structure of a business model canvas. Any final thoughts that you'd like to add?
Well, I would just say spend some time here and make sure you really are accurately accounting for all of your costs, because this is that big financial viability check for me when I'm helping organizations go through it.
And the last thing I'd like to say is I always look at when I'm spending $1, is it directly impacting my sales or is it not directly impacting my sales? And I'll break it up into those areas where if it's directly impacting my sales and it's increasing my sales, if I'm spending $1 and I'm getting $1.50 in return, I'm cool with that. But if it's not directly impacting sales, I tend to be very lean and mean on those expenses.
Absolutely.
Well, it sounds like a game plan once again.
Talk to you soon, Professor Palin.
Thanks, Ryan. Appreciate it.
Thanks for listening to our Favorite Tools for Entrepreneurs podcast. As always, you can head over to ProfSpirit.com to check out more resources and courses designed for you, the entrepreneur. Please follow us on Spotify, Apple Podcast, YouTube, and others to get the most up-to-date information as it is released.